So the first thing we'll talk about is an introduction to options. I'll go ahead and get started now. We just gave some time for other people to pop in. And then the first strategy we'll talk about starting at 8 p.m. is a married put. And then next we'll talk about a covered call. And then finally we'll talk about a caller, which is just a combination of the two strategies above. So there's really only two concepts that we'll be really going over. And then a combination of the two. And then something I really want to highlight throughout this is active management of these strategies. Cool. All right, so I'm just going to get started with the introduction to options. And I'm really excited to answer this question from Lincolnomics about the role options play in a diversified portfolio, and I'll show examples from my real positions, list of positions, and how I use them to diversify widely, especially now that commission went down to 65 cents. And yeah, I want to avoid any terms of gambling. I want to think more long-term, more like Costco shopping for options rather than buying lottery tickets every week, and seen more as assets than anything, casino-like, and definitely in terms of protection and things like that. And the question says, how many options should I include in my portfolio? I guess that would all depend on your risk tolerance, and I'll be glad to go in that in detail later for sure. So I'll start off with introduction to options, and let's see how this is working. And I'm definitely excited to come back to those questions. Those are all amazing questions. So first thing we have when we're talking about options, we think about what we all are somewhat familiar with, which is just a stock certificate. So this would just be XYZ stock. And you can go long this, you can go short it, you can take a long position, which is positive. You can take a short position, which is negative. And a quick way I like to remember that is long has a G in it. And with G, you can think of green. And it's a positive number. You have a positive position in your portfolio. And you can go short stock as well. And short has an R in it, so you can think of beet red and beetroots, which are red. And these are negative. So, yep, long, you can go long and short. The stock lasts indefinitely until it's delisted. So this stock can kind of we just kind of ignore it, but it does have a finite life, but it's just on our day-to-day basis, it just goes on forever. So it goes on until it's delisted. Now, people end up having large positions, and just in our case, we're just going to look at lots of 100 shares, but some people obviously have thousands of shares, millions of shares, especially when you're an employee of a company, a CFO, you're paid in shares. You may want to allow someone else to have access to those shares. And you yourself may want to have insurance on those shares. So there's what we call derivatives. So these are just, so let's say someone has millions of shares on XYZ, they're going to get trading rates on that, so it's going to be options. And there's two types of options that we're all aware of. So if you have the right to buy, that's a call option. And then inversely, there's a put option, which is the right to sell. And I'm going to abbreviate these from now on as right to buy and right to sell. So a call option would give us the right to purchase these shares, which I'm going to abbreviate as right to buy. At a put option, I'm going to abbreviate as right to sell. So these are the two things we're going to talk about, a call option and a put option. And these have defined life patterns much shorter than the life frame of a stock. So these have expiration dates. These are just contracts based on this stock ownership certificate in company XYZ. So if you want, you can take a screenshot of anything. If I'm going too fast, say, hey, go back a few slides or tape workspaces, and just feel free to let me know if you want to take a screenshot of anything. And this will all be available. I'll share it in a Google Drive with anybody who DMs me after. I will share this this worksheet, what I'm drawing on this board, with whoever sends me a DM after the message, or if you put your name, if you put hey in the workstation in the workshop discussion, you can just say hey in here, send this to me, or if you don't find the link, you can let me know and say I couldn't find the link. I'll be posting the link in the workshop discussion. So the first thing we'll talk about is a call, which is the right to buy or the right to sell. You think about a call, it's like you call someone you love to come to you, right? You say you have the right to buy something. But there's two sides to each option contract. So it can get confusing. There's a long party and a short party, like we talked about earlier, with G meaning positive and R meaning negative. So long, positive, red, short is red and negative. Long is green and positive, short is red and negative. So when you think about a call, it's your right to buy something. And the put is the right to sell. So we're going to look at this in terms of trading and being long and short. So I want to also think about ways to remember what a call option does. You can think of it like basketball, right? When you're playing basketball, you want someone to throw you the ball so that you can make it into the basket. And you're always saying, bring it to me. So it's like bringing shares to you. So this is your right to buy 100 shares of a given stock. And for each option, there's some basic principles. There's three basic components to every option contract. And this is expiry, strike, and premium. So E stands for expiration, which is just the life of the contract, because every good contract like health insurance, life insurance, whatever you have, you don't get to pay it forever. You pay for a certain amount of coverage. And then when you pick how long you're gonna insure your house for, like 3-4 months at a time, or you pay a year at a time and you get it cheaper or something like that. You also pick how much coverage you're going to have in terms of value. Like, I want to protect $1 million house, it's going to cost more to protect it. So that would be a strike. You can consider that to be your strike, to be the amount of property that you would be protecting with an insurance plan. And then finally there's premium, which is the price that you pay for any option. And does anybody have any, let's say, what are your questions so far regarding expiration, strike, and premium, and a call? I'll give a second to see if anyone has anything bubbling up in their mind they're ready to popcorn out with. If not, I'll carry on. So when you think about a call, you can think about like basketball, because the player is here, and here's his perspective, which you could think of as the strike. And then here's the basketball court, and his objective is up here, right? So he has the ball, and his goal is to get it up here, above the strike. Because above the strike of a call, here's his call strike at this level, which we could say just for fun is 10. When the stock price goes above that, his option is then in the money, because he has the right to buy it at 10. But if the price goes to 100, then he was in the money. by 90 points. This is definitely an exaggeration, but it's just to drive the point home. So you can see whenever this ball moves up above this strike, which is at eye level, then the call option will be in the money. It'll be a valuable contract to have, because if you're running around with Ford call options at 10, and then Ford is now at 12 or 100, you have a very valuable contract on your hands that's worth more than you paid for it, ideally. If the price increases dramatically, the option is generally worth more than you paid for it. But there are exceptions to everything. Okay, so just going to move along real quick. So a put is, on the other hand, and I'm just going to draw this one in yellow. So a put, remember, is the right to buy or the right to sell. The put option is the right to sell. So this gives you the right to sell something. Then you want to, whenever you buy stocks, you want to buy low and sell high. And conversely, when you're shorting stocks, you want to sell high and buy low. So that's kind of how a put can be advantageous. It's like if you insured your house, but you happen to insure it for lots more than it was worth, and let's say you insured your house at $4 million, and you showed them pictures of your house, and it looked like a glorious mansion, and then the house was burned to ashes, and you went to your insurance company and said, hey, can you cover me for this property? And then they cover you for the full value that they believe the house is worth. And I think there was actually like an insurance scam where people actually did things like this, and there's like a whole term for it in the insurance industry, but it's just to drive the point home. When you think about buying a put, you want to sell high and buy low. So when you're playing with puts, it's more like the game of golf, whereas calls are like the game of basketball, because when you're putting, you can think of it, you got your putter, and here's your golf ball, and here's your perspective, which is your strike, and we'll call it put strike. The put strike is in the money anywhere below the strike, whereas the call strike is in the money above the strike. And that's easy to remember, because the right to sell, you want to have more advantageous price. You want to be selling whatever you're selling, like Bitcoin, at 60,000 rather than selling it at 50,000 or something like that. So this is in the money below the strike, because then you have the right to sell for it at 10 when it's going for 5 or something like that. Or sell Viacom at 80 when it's going for 50 or 43, which was as low as it went this week. So you think of it like golf. When you think about the game of golf, your objective is below the player's perspective. Now, the thing about options is you can be long or short. So when you have a call option, there's one long party and there's one short party. And just to make this clear, I'm going to fill the whole page. So on one side we have a party who is long, and on one side we have a party who is short. So this is a call option. And let's just say it's a 10 call. And then the person on the left is short. Person on the left has a +1 position. The person on the right has a -1 position. Not sure what I said a second ago, but that's what I intended to say. So this person on the left is long. He has a positive position. The person on the right is short with a negative position. Person on the left has the right to buy, because remember, a call option is the right to buy. Then we're just going to flip the letters here and here to describe what the other party has, right? And I'll just write the whole thing out in case anyone's new to the terminology. And if you have any questions, I would love to hear them. Conversely, the person on the right has the obligation to sell them, to fill that contract. So it's like yin yang, right? Which is OTS. So we're just going to flip the first and last letters and see what we have there, right? And just to make that a little clearer, I'm going to try to rewrite that a little better. All right. So this situation on the right is only if exercised. So I like to put a star here, and the star just means if exercised. Exercised or by the long party. So I'm just going to say technically they would be assigned. So the person on the right, they may be a trader with a covered call or something like that. So they're playing defense. And then the person on the right is playing offense with this call, right? So he's going for the basket up high. He's trying to get there. And then player 2 is trying to block him. But he's going up there for a dunk, so, or layup. So, does everyone understand that? I'll give a second, and I'd love to hear what are your questions so far. Okay, I don't see anything yet. I'll come back and check. Feel free to finish typing them out if you have any. And we'll just quickly talk about a put option now. So this is a put. Remember, a put option, if you're long, is the right to sell. So this person's playing golf over here, you know, and he's trying to get into an objective down here below his strike. That's when the option is worth something to him so that he can make more money than he paid on it and then sell it. And then just like the other situation, there can be another player who's short. In this case, in the game of golf, you could imagine him like making noise or something to distract the other player so that he's not able to meet his objective. He loses if the stock, the person who's short a put goes down, loses money if the stock loses value below the strike price. So this is a put. The person who's long has the right to sell. And then if we just flip that, it's the obligation to buy. So we just flip those first two letters, the first and last letter, from right to sell to obligation to buy. Right? And so this is just like the last situation, only if exercised, right? So if assigned. And this person over here is very bearish, and this person on the left is neutral to bullish. He just sees this red line at some price on the chart, and he does not want the chart. He does not want it to go below that price. The person on the left sees a green line on the chart, and he does want the price to go down. He's very happy. This person will be sad, right? So this guy is going to be happy above this line and sad below this line. And inversely, this person will not make money on their put option. If it stays above this line, it'll expire worthless. And that's how that works. So that was a brief introduction to calls and puts. I would love to hear any questions that you have about that, if any. And there should be. This is definitely a lot of stuff. It's like a new language, so, and I'm sure a lot of other people have the same questions. So if you do have any, please popcorn them out. And if you don't want to say it in front of other people, you can DM me as well. That's totally cool. Okay, so I'll just be standing by for 5 minutes. So we'll just have a 5 minute bio break / waiting for people to start. And then we'll start at 8:05. Test, test. Okay, I just gave us 5 minutes just in case anybody showed up late. Looks like we got everybody. So if anyone has any questions before we start, I'd love to hear them. And if there's anything in particular about the married put, covered call, or the caller that comes to mind, let me know. And also, I'll be glad to share some real, like real world useful examples from these strategies that I used this week and that I could have used better this week. And I'd love to hear if anyone else has any better ideas or any responses after I share what I did. So it looks like my microphone's working. I'm going to assume it is. If anyone cannot hear me, if there's any silence for a while, feel free to let me know. So yeah, we'll just start talking about the first thing, which is a married put. All right, so first thing is a married put. And this is also called a protective put. And then you could also think of this as a hedge or something like that. But if you keep it as a married put, it's tied to shares and it is a defined risk strategy. If you just have a put alone and you have a full service broker and they're going to allow you to take assignment, or if they're going to allow you to exercise a long put if it is in the money and take delivery of shares, actually to take delivery of a short position if it's a put, because if you have the right to sell and you have a zero position, then you execute a sell order for 100 shares, you then end up with negative 100 shares in your account. And as we all know, stocks can go up to, they have no limit to the upside. They do have a down limit to zero. So that's why I'm sticking with a married put, protective put, as a defined risk strategy. And so what is a put? We just talked about during the introduction that a put option is the right to sell, right? So it's more advantageous when we have a put option at a higher strike. Like if we had a put option at 80 and the stock fell to 50, then we would have a very deep in the money put option that would be very advantageous, and we would then most likely in most cases will sell that option to somebody. So I'm going to go over this step by step. So this is the right to sell 100 shares. That's what a put option is, right? At a given strike. So what is the married put? The married put equals greater than equal to, we need to have at least 100 shares and one put and a long put. So this would look as something in our portfolio. It would be 100 shares or more, but for each put that we have, you need to have at least 100 shares. And so that's what this means. Greater than or equal to 100 shares. So we need 100 shares of XYZ. And then we need at least one, a positive position of +1 XYZ. And then we'll have three values of that stock, remember? And if anybody can remember what were the three components of an option that we just talked about, feel free to type them out if you remember. Three central components of a option are the expiration, the strike, and the premium for which you paid for that right to trade. So in this case, we have an expiration, and let's just say we have a 10. This is a date. So this would be, for example, 16 April, which is the next standard expiration. There's also non-standard expirations, which are either on Monday, Wednesday, and non-standard Fridays. There's a strike, so let's just say this is a 10 put, and there's a premium. In this case, let's just say it's 0.1, and that would be a total cost of $10. Because it's the right to trade for 100 shares, premium is always listed as price per share, the option contract, and then it's priced in how many shares it controls, which is generally 100 shares for equity options, for standard equity options. All right, so this is it. These two positions equals a married put. And so let's take a look at how that could have played out this week or over the past 20 days. Let's say we're looking at a chart of Viacom. And Viacom ran up in the past 20 days from 50 to 100, or about 60 to 100. So let's just say it started here at 60, and then Viacom over the past 20 days rocketed around, and then went to like 102, and then it promptly fell back to lower than 50. It went to 43. 43 and 102 is the high and the low. So let's say we had a put option. Let's just say we didn't see this whole history, and let's just say we're starting here at this time. And we're following it along and looking at the activity of the stock, and let's say we have 100 shares. So at this time we plus 100 shares. You don't have to open the married put right then and there. You could open one then and then buy another put later. But let's just say hypothetically we didn't buy it yet. Let's just say we bought 100 shares, we averaged in slowly over time, we got up to 100 or 200 shares, at least 100 shares. And over time we're watching this stock increase, and we've seen some dips and we see some rips. And we're thinking, okay, we're up a lot on this stock right now. If the stock was at 70 or so right here, we're thinking, we're up, 30 points on that stock. We had 100 shares. That means we're at at this point we would be at $3,000 profit, unrealized. And we're thinking, at this point we'd be thinking, I could sell all our shares, or I could buy the right to sell those shares at a much cheaper price. So we could say, you know what, we bought it at 50, I'm going to buy a 60 put just so that I lock in 10 points of profit. And that option, when we're at this point in time over here, then that 50 put or 60 put is going to be cheaper than it was at this point, because it's less advantageous at this point. So we're looking at, and we're going to create an open position here, and we're going to open a 62 put that expires in the 16th of April. So this is the option expiration, which is 16 April. So you can see this green line is like kind of attractive to the stock price, whereas if you have a short option that would become disadvantageous if the stock were to hit it, you would not want it to go to that price. So in this case, you have a green line there. That's like an insurance plan, right? So this is a 60 put plus 1 plus 1 60 put, right? And it has an expiration strike and premium, so it's a plus 1 XYZ, just to be specific. I have a plus 1 XYZ, and then the first thing is my expiration, 16 April. And then this is a 60 put, and let's just say hypothetically I paid 0.2 cents for it, which would be $20. So that was only $20 I spent when I was up $3,000. So it's a very minimal way that it's a minimal cost for a significant amount of protection. Can anybody tell me the max profit on this 60 put? And not talking about break-even point, just the simple, what's the simple max profit on a 60 put if someone just gave you one today and it was free. So I'm just going to see if anyone has a guess for that. Max profit on a 60 put. Any guesses? I'll give you a free imaginary Fluent in Finance t-shirt. I see the answer, and that's correct. The max profit is, so it's going to be $60 per share, and if the stock goes to zero, then it would be, $0 per share. So let's just look at it on a chart, right? The stock is at 60. If you have 100 shares times 60, you just do 60 times 100 because you have the right to sell 100. And then you just put you put all the zeros together, it equals 6000, right? And then the break-even point would just be $20 minus that, which would be $59.80. Well, I mean the actual max profit minus commissions will be that. I'm sorry. The break-even point is 60 plus 0.2, which would be 60.2. So the BEP, we don't need to know that. I'm not going to go. That's above this class, but just for your record, it's the strike, and then plus the premium that you paid. And if you're receiving a credit, then you'd switch it to a minus sign. So in this case, it would be 60.2. And that's the point where it has to fall below, wait, hold on, actually it's 59.8, sorry. Because we paid out. So in this case, it would be, yeah. So if you lose money, so if you pay for the option, you subtract from your advantage. So you would be at advantage at 60, but now you're really only going to make money if this option is only in the money or really profitable if the stock is below 59.8 per share. That's above and beyond this. I would love to know what are your questions so far, and I'll just give a moment to soak in the married put. So, yep, we have this open. This O means open. This position was opened here. When we were profitable, we were up $3,000 on the stock. And we said, you know what, let's just insure this position a little bit. And then we followed over time and we thought, oh, well, we didn't need to do that. Let's sell a couple of shares here if we have over 100 shares. And then you think, oh, well, it's good I sold those shares. Maybe I'll buy some more. Oops, that was a mistake. Okay, Goldman Sachs is liquidating somebody. Oh my God, I'm glad I have this put. And that's what happened, I guess. I didn't know this. Goldman Sachs was liquidating Archegos Capital. I don't know any of these hedge funds or what they do or anything, but they had a bunch of Chinese stocks, and they also had Viacom and Disney, and those positions were sold in huge blocks. And I'll pull up the chart and show you a real trade that I did in that as I was going through these emotions. And so yeah, the price of Viacom fell below the strike that I had, and I'll show that. And that option that I bought for 20 cents was worth $10 at one point. I sold it at 8.9, and then I started buying call options at this point. So I see a question about this concept, and then we'll move on to the next concept. This long put will compensate for the original investment, but not for the lost unrealized profit, right? I believe so, yeah. You would lose unrealized profit if you were sitting pretty at this position or this position, and then you bought this put. You could have sold it all here and made a lot more money, but then you didn't. But then you were protected here, so you would only make those $60 per share locked in from your put, which you would just think, oh, I'm being compensated by the increase in the premium of my put option. So this put option would then be worth a lot more money at this point, and it would be worth a lot more money at this point as it starts to go. So you could actually buy more puts than you had stock, and then you could make money if the stock went down. So that's a long put, technically called a married put, if you have an equal amount of option coverage per share coverage. And then I'm just going to answer this one question real quick. And then feel free to let me know if I did not answer your previous question. I'll be more than happy to clarify. So we have, is married put similar to a cash secured put? It is in some ways, but it's technically a different position because one is a positive position and one is a minus position. And that's a great question. But somebody on the other hand of this trade may have been doing that. So remember, each party in the put has a long party and a short party. So in this case, remember we talked about those concepts during the introduction. If you were here, we have this put option. The contract has two parties, right? Each single contract has two people, right? So it has a short party and it has a long party. So this person who has the married put has the right to sell, and the person on the other side has the obligation to buy. So this could be a cash secured put, and this could be a married put. And a cash secured put, just for the record, is you have the equity to purchase the shares. So you have the obligation to buy. You just have a negative put equals -1 put option with nothing else. So you would be then obligated to buy the stock if it was exercised, right? So then you would be assigned if it were in the money at expiration. The star means assigned the option. All right, so the next thing we'll talk about is an awesome strategy. It is called the covered call. Which we abbreviate as CC. So the covered call, this is simply the CC equals, you have 100 shares, so plus 100 shares or more, greater than or equal to, but you need to have at least 100 shares per option contract that you wish to do this with. And I personally recommend having at least 5 to 10 more if you intend on doing this strategy, because what can happen is the stock can go far above your covered call strike. So this is plus 100 shares and a -1 call. So I'm just going to scroll back one. Married put is simply plus 100 shares and a put, right? I think I meant to say a married put is 100 shares and a long put. A covered call equals 100 shares and a short call, right? So this is just 100 shares and a short call. And this is why the brokers allow you to do this strategy, is because it's a defined risk strategy, as opposed to undefined risk with unlimited maximum loss. So in this case, the worst you can lose is the price of those 100 shares, which would be offset by the premium you received for the short call. So let's just say, for example, we have 100, this is how it would look in our positions. We have 100 XYZ, and we have -1 XYZ, and then the three components: expiration, strike, and premium. 16 April, and then let's say we purchased this 100 shares at $10 per share. It's our cost basis. And then we have a 16 April, and let's say we have a 15 call, and the premium we collected for it, let's just say we collected $1 of premium. So the total you receive for selling that option would be $100. And one thing people like to do with this strategy is to imagine that it offsets their cost basis. There's nothing wrong with that. You can say, well, if I received $1 in premium, that's like taking 1 point of my cost basis. So I could say, I can then imagine that my cost basis has now gone to $9 per share. And so now I'll show how I like to look at this on the chart. And if you use a broker like Thinkorswim, they'll actually show you the red line on the chart. It'll say like a little line here that says like 15 call, and it'll say the date. So here's our XYZ stock. And let's say you bought in at 10, and it's just kind of chopping between 12 and 11, 12 and 11. And then you have a red line at 15. So this is 15 and 10. So you are neutral to bearish in this strategy. This is neutral. This strategy is neutral to bearish. And just try to move this down a little bit. So, because you are sitting here, and of course you're bullish in the sense that you want your stock to increase, right? And then above this point, it's going to be in the money. But for you, it's not necessarily, let's say, I'll put it all in the perspective of the trader. If it goes, this is a short call, and the stock increases, there's 3 different levels it could be at, right? I'll put level A, which is above the strike, and then level B, which would be below the strike. And if we go out in time and the stock can move it to either here or it can move to here, as we move forward in time, in situation A, the option will expire in the money. It'll be automatically settled, and we'll have to sell those 100 shares to a 0, right? So we start with 100 shares, then the option is assigned, which I'm just going to draw as ASSN, and then we end up with 0 shares. The call option is no longer in your positions. The shares are no longer in your positions unless you have more, which is why I recommend buying at least 5 to 10 more, whatever is within your risk tolerance. That could be 1 share, it could be a fractional share. Just always stay within what you have set as your risk tolerance, which for me is like 1% of my total equity per trade or less. Very conservative personally. So situation B, this is below the strike, then the option expires worthless. And you collect all the premium. All that equity that was already increasing your buying power stays there. The option is no longer in your positions, but the shares are still in your position. So you still have 100 shares, and then it expires, which I'm going to draw as EXP, and then you still have 100 shares. So no change. No one executed a trade on your behalf, and that's how this trade worked out. We finished the covered call with some time. Does anyone have any questions about that? Or what are your questions about that before we move on to the caller at 8:40? So we have about 10 minutes if you want. I would love to hear any questions if there is any. I see one from the last one. It says, what makes a weekly option if I can sell or buy one that is weeks out? How is it weekly then if I need to keep it for a month if held to expiration? And the same with monthly. Okay, so what makes a weekly option if I can sell or buy one that is weeks out? All right, so oh, you don't need to keep it for a month. You can cover it any time. That's why I like to say in this case, there's three scenarios with an option. There's either trade, exercise, or assignment. So TEA, right? And I like to think of it in that order. Trading is far better than being exercised, which is slightly better than being assigned in general, but these are roughly the same. But so there's trade, exercise, and assignment. So I'll just draw a slash between these two. This is exercise, and this is assignment. So you don't need to wait until expiration or hold it till expiration. You generally want to just trade it whenever it's advantageous. So if you sold the option, then you could buy it back at a lower price, which would be advantageous. Or if you were long the option, you could sell it at a higher price, which would be advantageous. And the price of the premium of that option could increase or decrease due to forces like change in the stock price, current events, supply and demand, just people going crazy for that stock, or just implied volatility. If the price changes considerably on a daily basis, then the premium of the options will become cheaper, and vice versa. So yeah. Another question, is there a difference between selling or buying a weekly option that has an expiration 4 weeks out or a monthly option with 30 days out? Okay, so that's a great question. So these all have just an expiration date that's determined, and that's why I like to show an option chain, which I'm going to pull up right now. If it pops up, and can anybody see this okay? So here's an options chain, and what we're looking at here so we'll just go to SPY, because that is a good example of weeklies and a highly liquid security. So here is just all the stocks. You can just imagine them. You can just look on the calendar and see the date to find out what they are. So let's see if I can do that real quick. So I'm just looking at a calendar, and let's see, 2nd, 9th. So hold on 1 second. Oh, right. So April, there's a holiday, and the next one's going to be on the 9th. So these are Fridays. These are Wednesdays. And then these are Mondays on 5 April, I think. Let me check. Yep. So these are just Monday, Wednesday, Friday. So I'll draw it out for you. Standard. This is 3rd Friday. And then there's weekly, which for most stocks is on the non-standard Friday, but it's either going to be Monday, Wednesday, or non-standard Friday. So you can see all these expiration dates here, and then you can just go through and select whichever one that you want to trade. And there's no difference at all between those, except for they become less liquid for some stocks. For SPY, these are all generally as liquid as one another. There's no difference. Like if I look 7 April, all these spreads are going to be 1 penny wide, in general during market hours. After market hours, there's going to be, a 4-cent, 5-cent difference, as you can see here, from 160 to 165 on the 388 put, which is on the right side. So remember, on the left side there's calls, and on the right side there's puts. And then so these are in the money on this side, and these are in the money on this side. Oh, it's not showing. Anyway, you can see the puts are in the money just below there. Let me see if I can drag that over. There we go. So there's a in the money point wherever it's shaded in, where it's more advantageous to have that call option on the left and more advantageous to have the put option on the right. Cool. All right, so I'll just go ahead, unless anyone has any other questions, feel free to shout them out right now. The next topic will be the collar. So a collar just equals a covered call and a married put. So in this case, you have 100 shares. It's a combination of the call and put in addition to 100 shares. So it's not necessarily covered call and a married put, because you're just thinking about the option sense, right? So if we're only looking at the options, we have 100 shares. And then we have a covered call, which is -1 XYZ, and then 50 expiration strike. So we're just going to say 416, and it's a 50 put, and we collected, wait, hold on, covered call, whoops, let me say 100 call. Let's move it over. So we have plus a CC, which equals -1 XYZ, 100 call, and let's say we collected 0.5 premium. So we have our expiration, our strike, and our premium. See another question? So the day it expires doesn't necessarily affect your decision to enter the trade? Nope, the only thing that really matters is, well, for me, I like longer term. Unless I'm selling premium, then it all depends. If I can get premium for a short, I go out as far as I can find premium. And liquidity is number one. So I don't really like to trade on things that have wide bid-ask spreads, which you can see here when you're looking at the spread from the bid to the ask. So you can see these columns where right underneath where it says puts, you see bid and ask. So that's where people are willing to buy and willing to sell. You want to see that to be very narrow. So I'll just write that on the bottom left. Bottom right, you want to see narrow bid-ask spread is the ideal. That's the one thing I really look for in when I'm trading option, not necessarily the date or the premium. One thing I really want to know is whether I can get in and out of that position with ease, so we need liquidity. So, moving on with the collar. So we have plus 100 shares, then we have the covered call, and we have a married put. And I'll just say like component A and component B would be both together. And then we have so this is going to be a +1 XYZ, same strike. And then let's just say it would be like an 80 put. And we purchased it at, let's just say hypothetically, we purchased it at the same price that we sold the covered call for. So in one case we sold an option, which was this one in red. And in one case we purchased an option contract in this. So I have a question, if anyone wants to play along for imaginary prizes. In situation A, can anyone guess? Can anyone guess? What was I going to ask? Situation A. Yeah, is this the obligation? How does this trade? What is the covered call? What is that? What is the option and what does it entitle you? So can anyone tell me the option and the rights or obligations? So it's a covered call. So a call option is the I see the answer, yep. So a long call is the right to buy, and a short call is the obligation to sell if exercised. So in this case, short call equals obligation to sell star if exercised, which can happen before the settlement, if the long party exercises it by mistake, or maybe they want to take a dividend or something like that. That's why they call it dividend risk. Someone can take your shares away prior to expiration, or another situation would be just they made a mistake. Because if you look at your options in your portfolio, which I'll show you here, you go to positions. These are all fake positions, by the way. This is paper money, but I will be showing some real trades later. If you look in here, you see here's an option contract. This is a 303 put. And then if you look at the last option on the right, it says exercise option. And if you click that, it takes you to the exercise order ticket, right? And they can do that by accident and click this paper trade thing, and then they exercise that option, right? So they can do that by mistake, where they're a new trader, they're just trying it out. It doesn't really happen too often, but it does happen on occasion. So you have the obligation to sell if exercised on the top. Y'all got that? Can anyone guess what situation B is? Do you have the right, obligation, etc.? And I'll be glad to show you that. And anybody who wants to see how to use the application to see those options and the pop-up windows, let me know. And also if you think, hey, let's do a workshop on different brokers or something like that. If you have any fun ideas for different brokerage or different option strategies or anything, or just like a day, what I would do in a day or something like that. If you have any fun ideas, please throw them at me, popcorn it out. Either say it right here in the chat, in the main channel, or if you don't want to say it, you can say it to me privately. So can anyone guess in situation B, what are the rights or obligations of this side of this strategy? Of the married put. Does anyone remember that? And I'll give a minute, I'll sip some water and chill. And I encourage everybody to take a second, close your eyes, go get up and go for a walk, let your dog out the backyard. We'll take a minute here just to talk about this strategy. Don't burn yourself out. Let's talk about it for a little bit. It's very close. On the other side of the strategy, that would be correct. Does anyone else have any other guesses? And that is definitely a perfect guess. Yep, a long put. This is a married put equals a long put. And then the way to remember that is RTS, right to sell. And I'll scroll back up to that from the intro class that we talked about. On the right side, we have the obligation to buy. And on the left side, we have the right to sell. So this person's long, this person's short, this person has a -1 position, and this person has a +1 position. So here's a contract, we cut it in half and we give it to one person. The person who's long has the right to sell, the person who's short has the obligation to buy if exercised. So when the person on the side right, he's not going to have any of those fancy options come up when he's looking at his broker. So if I show you a short position here, and then we see this 425 call, which I'm going to click on now. I don't see this exercise option button. It's grayed out, and when I click it, nothing happens. So that's under create rolling order, which you can see under all the options, starting with close position, create the chart for this option. Create an alert for this option, which is a great thing to do. I love this app for that reason. You can get a text message alert, email, or just a push notification. And then my other favorite thing to do is look at the details of this option and look at the chart over time. So this is a really nice feature to have. And you can see actually how the premium of this option changes. And then you can go back and look at SPY and compare that to how the premium of the thing. So this is Thinkorswim Mobile. This app is Thinkorswim Mobile. And this is the iPad edition. And then also, yeah, if anyone has any questions after, like, hey, what is the broker? What do you want to, how does that work? And then also I'll be more than honored if anyone says, hey, send me a referral link. I'll be so excited if anyone does want to. I'll share all my referral codes for E-Trade, Tastyworks, or Interactive Brokers. So there's Thinkorswim Mobile, that's what we're talking about, and this is, there is also a web version and there's also a desktop version. So I just call them TOS Mobile, TOS Desktop, and TOS Web. And then this one's iOS that I'm familiar with. So there's 3 different platforms. The web app is fastest, desktop is most versatile, and the mobile app is just the most fast, most intuitive. So, all right. If there's any other questions about the collar, I'll be glad to field those. Everyone seemed to understand that this side up top is the obligation to sell, and the tide on the bottom is the right to sell. So it's like, I either have to give away those shares if they go over $100 per share by settlement at expiration. And I'm going to go ahead and pop this off. So in situation A, this leg A, we have the obligation to sell if by 4/16 the price is over $100 per share. So if it's at $100.01, then the broker will execute this contract. Trader will be assigned, which means they will sell 100 shares at $100 per share, and hopefully they're taking a profit at that price level, and they collected 50 cents a premium, which is $50. But there's no net gain for this because they had this put. There's no the contract doesn't, the options, if you're just looking at the options, they're offset by the cost of this put. So it was basically paying for a free put. You see, because these prices are equal, you received a credit here. So you got paid here. So this one there was a credit. And then this one there was a debit, like a cost out. And then this one was credited with premium. So what are your questions? What about this do you want to talk about? What about this is on your mind? So right, they can be at whatever strike and premium you want to do. So I'll show some examples. And we can just look at a calls and a puts together. And we can just say, let's say SPY's at 390. Let's say we bought it at 250 during the crash of March 2020. And then we're looking at the price now. and we think, you know what, I would sell maybe a 420 call option. So let's just look at that, and then let's see if I do that, what's the most expensive put I could buy as protection. Oh, there's no premium in that, so let me go a little lower. Let's go to 400. Okay, that's better. So let's do a caller example. So let's say we have plus 100 SPY, and then we do a -1 SPY 16 April 400 call, and a premium of 3.23. So, and then the advantages of this is you're offsetting the cost of protection, right? So I'll write that down just above here. So Y collar, which is the advantages of it. So you get a discount. These are ways to look at it. You can say it's like a discount on your hedge, discount on put, or free put. Because the price that you collect in credit, the premium collected, offsets the cost of the premium you pay. Premium collected from covered calls offsets the cost of married put. Sorry it's so sloppy. So yeah, premium collected on a covered call, it offsets the cost of the thing. Cool. So no, they can be different, but they're technically the same. Like, it's most colloquially known as like a vertical strategy, where it's both the same expiration, but it doesn't have to be. And that's the best question you could ask, because you really want to be talking about whether you're doing you're getting creative with your protection. You know, maybe you sell a covered call, one whole standard expiration out, but then you buy, well, let's go 3 months out or 6 months out. So you sell a covered call 6 months out, you have 1,000 shares, you just sell one covered call and say, you know what, I'm going to buy some puts in case this thing goes down. And I'm going to do that by selling calls. So I sell a covered call at 400, and then I buy a SPY 200 or 295 put or something like that. So just to continue with this example, and if I went off topic or forgot to completely answer a question, please redirect my mind, but I thought I addressed it. So, and then let's say, for example, let's go shopping now for a different, same or different expiration. So I'll just say hypothetical different collar examples. Let's just go one with like a standard one. So here's the options, and then here's the shares, right? And then, so let's go option shopping right now. So we went for the the call, which is on the left. We have calls on the left. Now I'm going to scroll up and look for an option that's hopefully less than that, but not so far less than that, so that I'm still making some money, maybe. So let's say I buy a SPY, 16 April, and let's just say a 388 put. And then the premium we pay for that would be 3.05. So then you can subtract the difference from these. So we have so the total collected, the net premium would be premium paid. You get a net credit. equals 18 cents minus commission. And so in this case, you got a free put, but you offset it by giving someone else the right to buy your shares. So you took the obligation to sell here, right? And remember, think about this like as if I'm asking you and we're like right in front of each other and you're thinking, what is leg A responsible for, right? We have leg A and we have leg B. What is leg A? Leg A is the, and you can just say it in your head, you don't have to type it out, but if you do, that would be super exciting. And then think about the rights of each strategy and the obligations. Leg A is the, and I'll write it in a second, obligation to sell. Leg B is the right to sell. So we kind of use this strategy to pay for this one, right? Or discounts it. So I'll let that soak in for a second, and I'd love to know what your questions are. And then we're running at an hour now, so we can do a Q&A, and I can pull up some real trades and show how we use these strategies this week. Okay, so I see some more questions, and if I missed any other ones, feel free to let me know. So are CC and MP done with the same expirations? Oh yeah, we already answered that. So it can be one or the other. You can do the same one, or you can say, you know what, I feel like buying an even cheaper put. I'm just going to go 2 weeks away. Or if I sold the covered call at 3 months away, maybe I'll buy the married put at only 1 month away. However you want to do it. You could even buy the put at a longer distance to get more protection, and then just sell a call at a shorter date. And then so there's two legs. You can, at that point, if you go to a calendar, then you're going to think about your legs as being back and front. And then you may want to keep buying front legs as time progresses, right? Until they get towards the back leg or something like that. And then if you have more questions about that after this, we can all go to a voice channel, or we can maybe unlock all the voices in this one, but if not possible, I'll say, hey, let's go hop over to like a general voice channel or something after this, and let's just hear live questions and get a real conversation going, and other people can provide answers too. If anyone wants to, if you're feeling bored during quarantine and whatever, just want to have a conversation. So next question. So for a caller, ideally you don't want to sell or buy, right? You can collect the premium for both. You're close. So anytime you see plus, you're paying out. And anytime you see a minus option position, you're getting a credit in. So remember one side. So you are paying a premium for the long leg. So I'll write that out. And this is such a good question, remember? So remember long equals, we're going to look at the green and think green, and it equals positive. And then you're generally paying for something, right? So then you're paying. And then just in general, this is all in terms of options. A short, you're going to look at the red, so that is red, and it's negative. So if you're on the number line, here's the number line. Here's 0, here's -1, and here's +1. And then you're getting paid a credit. So they call it credit because you don't really get it until expiration. So it's like a credit card. You pay, but you don't really have to pay it off until it settles at the end when everything's done and you've paid your statement. So in the short, you're selling an option, someone else, you have these two parties to an option contract, right? There's someone who's long, someone who's short. This is one option contract. It gets torn in half, and there's trader A who's long, and there's trader B who's short, and then you just have to think about the game they're playing. If they're playing calls, it's basketball. If they're playing puts, then the sport they're playing is golf. Oh, so yeah, do you understand that, Minster? And if not, feel free to clarify. So yeah, you pay for this side. This side's long, so you pay a premium and then collect a premium. So in this case, in the case of a caller, there's two strategies, right? There's strategy A and strategy B. And in one side you are, let's say here's our put. Excuse me. And then, well, let's put it off to the side. Put and a call. So we are going to look at which side we're taking on this strategy. So let's get proactive and try to guess it. Try to guess before I say it. I'm about to say where we stand in this strategy, right? So and then I want you to think about it when you're looking at a caller. And then I'll draw it in a different color. So let's say I'm gonna take one of these sides, right? So in terms of put, I'm gonna take the short side or the long side. In terms of the put for a caller, I am going to take the exactly, yep. So Anthony said we're going to be long for a put and short for a call. Thank you so much. That's right. So we're going to be long here, and then we're short here. And those are our strategies and the two options that we're engaging with. So in one case, we have a positive position, which is the right to sell if it's a put, right? And then the other case, we have a short position, which is it's short call, which is the obligation to sell. So in terms of like forgetting all the jargon and things like that, we just have 100 shares, XYZ, and we have a right to sell and a obligation to sell, which helps to pay for the right to sell. Because we collect a premium for this one, and it goes towards the cost of the protection. So this is technically like free collection. So let's look at free protection. So let's look at the three strategies again. We have a covered call, a married put, and a caller. So a covered call is like getting paid for your limit for a GTC order. It's like getting paid for GTC limit order. And if the order doesn't fill, you get the money. If the order fills, you get the money and you sell your shares, right? And drop a question if you don't understand that and want more clarity on that. That is very confusing, so feel free to clarify. So this is just ways of looking at it. This one's like getting paid for your GTC limit order. The married put is just, protecting yourself, protection/hedging. And as we saw, it's much cheaper than shorting. You're tying up far less equity. If you go to short a stock, you're going to be paying tons of margin fees to borrow the stock and things like that. It can be very, very costly to borrow that money, and it puts you at undefined risk, unlimited until your broker gives you a margin call and they could close your positions. So married put is a very attractive strategy for protecting long positions or hedging on positions you don't have, but you just have to make sure that that long put does not get exercised. So if you're in the money, just sell it and take the profit from that option. If you're busy and you can't manage your portfolio, but you do have a phone, call your broker and tell them, hey, look, don't exercise this, sell it, do a cash assignment, do what you need to do. And if it's a good full service broker, they should be able to do that for you. So we're going to consider this to be protection or hedging. And then the last case is also protecting and a hedge, but it's a cheaper protection with capped profits. So let's say you're already up 20 points. You say, I'll sell another covered call another 20 points higher and use that to buy protection for my long shares. So that's it. We talked about three things. We did an intro to options, and then we talked about these three downside protective strategies: the covered call, the married put, and the collar. And then I'll be recording this. So I am recording this now. Everything went well, so I'm just gonna straight up upload this afterward, and as soon as it's done, I'll post the link in here. Let's see. I'll just post my referral links in here if anybody is interested in signing up for one of these brokers. And then if you want to see how any of these brokers work, let me know. And then also, I'm going to try to see if I can enable voice in here. Let's see if that works. Probably won't be able to, but that would be cool if I could. No. Let's see. Yeah, I don't see a way to allow voice. So I will just show real quickly a real example of some trades. So it'll just take me 1 second to pull up and how I did this week. Let's see, just 1 second. Okay. Okay, so okay. So here is a chart of Viacom, and I was trading this one. I had a modest 20 shares that I had purchased somewhere back in time when it was probably before the crash of, shortly after the crash of 2020. I just ran around buying like 5, 10, 20 shares of different companies because insurance commissions had just gone to zero, and I was like, woohoo! And then, of course, everything was cheaper, so I was like, that sucks for people who had these positions, but it was a good buying opportunity. And so I was in Viacom and then tracking it over time, and I said, okay, I'm up, I had 20 shares that I had bought at like 40 or 30 or something like that, and then it was going up over time, and I was thinking, well, this is going pretty sweet, but I don't want to just sell the shares. I only have 20, so what I will do is I'll start buying puts. So I was selling put spreads, which is a whole other concept. Don't worry about that. That's another day. And then I'll go over that later if anyone has other questions about it in one of the voice channels, because it's so much easier if I can hear what part is causing like a lack of total clarity. But I'll just say real quick, what I did was buy a bunch of puts. So these are all puts that I purchased on 3/16, which is near the 52-week high of 102. So it was on this day of trading right here that I purchased all those. I thought, well, it's hitting this price. I don't know what's going to happen. I started buying a bunch of puts. The price went down, and I said, well, I'm glad I got those puts, but I'm just going to wait and sit tight. And it started to go up again, and I thought, okay, let's just see what happens, getting kind of nervous. And then the next days, apparently what other people are telling me is I guess it was a block sales. Again, I have no idea what these terms mean, but I guess Goldman Sachs was doing block sales and liquidating positions from Archegos Capital. Don't quote me, but I'm just providing sources I was reading over what happened, and it was in pretty credible news sources in Financial Times. So that was where I read that. And then so I was holding tight. These prices started going down. So I had a long put, a long 82 put, right? So it started to go in the money here. And I thought, well, this is pretty sweet, but let's just sell another put to create a spread. I did that for my 82 put, which is over here. And that's complicated, but just know that I had a bunch of long puts, which I considered to be married puts because I have essentially some long shares in this stock. I did also have some long calls, so you can consider that to be the shares, and I was protecting those with married puts. Similar, these functioned as if they were, tied to shares, and I was protecting my position. And I bought it more. I could have just bought one put for the same price, but I wanted to be able to sell at different strikes. Sell at different price points. So let's say it starts going down. I want to sell one of my puts here, and then if it starts to go back up, I say, whoops, I guess I should have sold them all, or at least I'm glad I sold one, which paid for all the others, which is what I tend to do. So as it started to go down, I sold one of those puts at a price that paid for all the others. And then it kept going down, and I kept selling puts. So I sold like another one of these. The first thing I sold was the 50 put, which is this one. The first thing I sold was the 50 put, which I sold at 8.9. Which was a price greater than all the others that I had, right? All together. So I said, I got my profits. The rest I can let them run if I want to make more profit, which shortly became possible as the price of Viacom continued to drop. And then I sold some more puts, and then I also wrote put spreads on these other puts here. So then also I did spreads and sold others. And I can go more into detail about that if anyone's curious. So I'll just say, hey, does anyone have any questions about any of this? Here's a real life example. Are you curious how any of that happened? Do you want to see more details about this? And it's always going to start off feeling very advanced. It's a very new language. So that's why I try to use fun like mnemonics and little like iconic reminders like a call. What sport is that? It's basketball. It's the right to buy because you get more advantageous as the ball goes up to that basket way in the sky. And that's if you're long, right? So you're thinking about both of these sports as if you're the long character. What are your rights? You want to have the right to buy something at a lower price, and then which you would allow you to then be at a sitting at a higher position of equity if you had purchased them at that lower price. It's like instant arbitrage. So you would buy 100 shares at $10 and then sell them at 100. Example, if it was a 10 strike that was 90 points in the money, just to make a fun, clear, vivid example. That is not to say that happens. Generally, you buy a 10 call, and the best thing that happens is it goes to 12, and you get 2 points in the money. And then a put is the right to sell, right? Because you're playing golf. You're looking at the golf course. You see all the objectives are below the eye level. They're below the level of the ground even. So that's like a put. You're looking down, you want to have the right to sell high and buy low. So your strike of your put becomes more valuable as the stock drops below the surface of your strike. And then it becomes in the money and advantageous. And yeah. And if you found any of that helpful, if you have more helpful examples, you have any feedback, I'll also make a Google feedback form right now, and then I'll post a link to one of the voice channels if anyone else wants to hop over there and continue the discussion with audio. And you can type as well, or just DM me any other questions. So real quick, I'm going to make a link for feedback. Okay, and then let's set the sharing settings. Okay, I'm about to post it now. Okay, and then I'll also upload the video as soon as I'm done, and I'll share the channel, everything I'll do here. Yep, so that'll happen in a second. So as soon as we wrap up, we'll wrap up and upload, share link after. In fact, I'm going to stop recording now and then start another recording for Q&A. If anyone does want to. If no one does, you won't hurt my feelings. So let me just stop recording this now.